Brett Kamel, former head of Remgro's venture capital arm, Venfin, returns to his Cape Town office optimistic about the opportunities in South Africa. As an entrepreneur himself with numerous hits and misses, he believes the proverbial equity gap, specifically early-stage financing, is the missing link in SMME development.
Because angel investment is new here, people need to be introduced to the right ways of doing things with early-stage investment. How do you invest into two young guys with a great idea? And that's a real challenge, knowing all the norms, how much equity you can ask for. So we bring an extremely experienced team, probably one of the more experienced early stage investment groups through our team management to bear on each of these deals. And so we advise both the angels and the entrepreneurs, walk them through the process, and then we stay involved afterwards to make sure that that business gains in value and eventually reaches a point of maximum profitable or a profitable exit.
Technology mecca Silicon Valley in the US was founded by the Band of Angels in 1994. Since then, almost 800 angel groups have sprung up globally, but South Africa is lagging the trend. Of the total value of venture capital transactions reported in the country between 2000 and 2010, angel investments represents a mere 5%.
It's not always easy to exit them in this market. It's very easy to get private equity funding for a business that's 5 or 10 years down the line, has a proven track record, 10 years of profits, but to get that for a business that's 3 years down the line, that is maybe about to hit profits, but right now is full of promise, far more challenging. Other markets such as the US, Canada, and even some of the emerging markets have a far better track record of exiting those. So much so that in our experience we've had to actually start looking at international exits. So we've had to put in a lot of work to build international networks.
One company that has capitalized on the gap in the market is Richmark. The company with offices here in Sandton, Johannesburg, now has around 100 investments ranging in value from a few R100,000 up to R1 billion. One of its investments, Blue Chip Media, has grown in value tenfold in just under 2 years.
Our vision is to take touchscreen technology to the end consumer. It's really converting physical printed material into an electronic format. What the product does is really it becomes a silent salesman. So when a consumer walks into store, they can make an effective decision on what they're trying to purchase. So really they can compare products, interact with the product on a live device, in this case mobile. It'll give you a little bit of detail on the device, obviously the pricing, and they can compare. So the sale is already done.
As investors shy away from volatile, risky markets and banks hold back on granting credit, angel investing is growing in appeal.
A lot of people are going to banks and getting denied credit. It's about capital adequacy ratios and that type of thing. So we're seeing a lot more people approaching us. We're being inundated with business plans, but there's only so much we can commit to in terms of time and resources at any given point.
Cape Town-based technology entrepreneur Eric Edelstein believes that angel investing is becoming a lot more sophisticated, but the price tag entrepreneurs set is a key factor.
For me, one of the biggest deal breakers, and I think this is for all angel investors, is the valuation of the company. Because in the angel space, there's a certain range that angels are prepared to back in, and if the entrepreneurs want to give away too little equity or want too high a valuation, the angel investors will often back away even if the idea is a good idea. The angels need to have a high return on their money. In the venture capital space, they're looking for a phenomenal return. The example I've read about recently was that NEA, a big venture capital firm in America, put, I think it was $2 million into Groupon. So far they've received $75 million out of it, and they still own a significant share of Groupon. That's the type of returns that angel investors and venture capitalists are looking for.
According to Richmark's formula, startups are considered a winner if they can double cost while halving revenues and still turn a profit. But South Africa still presents its unique challenges.
SIPCOM is a major barrier. There's huge delays in registering businesses and updating statutory details. The government could do more in terms of public-private partnerships and funding those. They could also allow more tax incentives, allowances and exemptions.
We really are lagging behind some of the incentives that have been put in place, particularly as an example the UK, where you can get 50% of your investment as a deduction. Part of your investment becomes tax-free after 3 years. So there's some really good incentives to drive that investment. Often, I think in the past, many people have looked at the angel sector or the wealth individuals and thought giving tax breaks in that sense is maybe benefiting the rich. But actually in most of the markets where angel investing has been operating for years now, they've seen the massive drive of money into early stage business and how that has then had a knock-on effect into the SME sector. Because the government has done things with the Jobs Fund, but a lot of those have been aimed at bigger corporates. We need to see more incentives driven to get people who have money and interest and people who want to support the sector, that gives them the tools to be able to do so. Because that's really the only place that we're ever going to get the sustainable jobs is if we start driving small investment growth.